Welcome back to Invest with Alex, the podcast where we break down investing and finance so that you can make smarter money decisions. If you're new here, make sure to subscribe so you never miss an episode. Today, we're tackling a financial concept that affects everyone, whether you're an investor, a saver, or just someone buying groceries: inflation. You hear about it all the time in the news, politicians talk about it, and economists study it, but what is inflation, really? And more importantly, how does it impact your money? By the end of this episode, you'll understand how inflation works, why it happens, and most importantly, how to protect yourself from its effects. Let's dive in. Inflation is the gradual increase in the prices of goods and services over time. It's why a gallon of milk cost much less 20 years ago than it does today. In simple terms, inflation reduces the purchasing power of your money, meaning that over time, the same amount of cash buys you less. To put it another way, if the inflation rate is 3% per year, something that costs $100 today will cost $103 a year from now. Doesn't sound like much, right? But over decades, that can seriously erode your wealth if you're not prepared. Inflation is measured by looking at the average price increase of a basket of goods and services, tracked by something called the Consumer Price Index, CPI. When CPI goes up, it means inflation is rising. So, what actually causes inflation? There are a few key factors, and it's important to understand them if you want to grasp how inflation affects your financial future. Demand pull inflation. This happens when demand for goods and services exceeds supply. For example, when the economy is strong, people spend more money, businesses sell more products, and prices go up because companies can charge more. Cost push inflation. This occurs when the cost of production increases, causing businesses to raise prices. Think about what happens when oil prices rise, transportation costs increase, and businesses pass those costs on to consumers. Monetary policy and money supply. When central banks, like the Federal Reserve, print more money or keep interest rates low, more money circulates in the economy. If too much money chases too few goods, prices rise. Government policies and regulations, things like stimulus checks, wage increases, and trade policies can also influence inflation. For example, if the government raises the minimum wage significantly, businesses might raise prices to cover the added labor costs. Inflation isn't always a bad thing, it's actually a normal part of a growing economy. But when it gets too high or out of control, that's when problems arise. Now let's get personal. How does inflation affect you, your savings, and your investments? Your savings lose value. If you have $10,000 in a savings account earning 1% interest but inflation is at 3%, you're actually losing money in real terms. This is why keeping too much cash in a low-interest savings account can be dangerous for long-term wealth building. Purchasing power declines. Prices of everyday goods like food, gas, and housing go up, meaning your salary or fixed income won't stretch as far unless your income increases at the same rate as inflation. Borrowing costs may rise. When inflation is high, central banks often raise interest rates to slow it down. This means loans, mortgages, and credit cards become more expensive, making it harder to borrow money affordably. Investments can be impacted. Inflation affects different asset classes in different ways. Stocks may do well if companies can raise prices, but bonds often struggle because rising interest rates make existing bonds less valuable. Real estate and commodities like gold tend to perform well during inflationary periods. So, how do you protect yourself against inflation? Here are some strategies that can help. Invest in stocks. Historically, the stock market has outpaced inflation over the long term. Companies that can raise prices during inflationary periods tend to do well. Consider inflation-protected securities. Treasury inflation-protected securities (TIPS) are bonds specifically designed to adjust with inflation, preserving your purchasing power. Diversify into real assets. Real estate, commodities, and precious metals like gold and silver tend to hold value during inflationary periods. Look at high-yield savings and CDs. While cash loses value over time, putting it in a high-interest account or a certificate of deposit (CD) with a competitive rate can help mitigate losses. Invest in dividend-paying stocks. Companies that consistently increase dividends can provide income that keeps up with or outpaces inflation. Stay ahead with wage growth. If possible, negotiate salary increases or seek income sources that adjust with inflation. Side hustles and passive income can also help cushion inflation's impact. To put things into perspective, let's look at some historical examples of inflation. The 1970s Great Inflation. Due to oil shocks and poor monetary policy, inflation soared above 10%, leading to stagflation, high inflation with slow economic growth. Hyperinflation in Zimbabwe. At its peak in 2008, Zimbabwe's inflation rate hit 89.7 sextillion%, making its currency worthless. Recent inflation surges, in the 2020s, supply chain disruptions and government stimulus contributed to inflation spikes in many countries. Understanding history helps us see the patterns and prepare accordingly. Alright, let's wrap up with some key takeaways. Inflation is the rise in prices over time, reducing your purchasing power. Causes include high demand, rising production costs, government policies, and monetary expansion. Inflation erodes savings, affects borrowing costs, and impacts investments. To protect yourself, invest in stocks, real assets, inflation-protected securities, and consider diversifying your income sources. Now, here are 3 action steps for you today. Review your savings and investments. Are you keeping too much cash in low-yield accounts? Consider adding inflation hedging assets, stocks, real estate, or inflation-protected securities. Stay informed. Inflation trends impact everything from groceries to interest rates, so keeping an eye on economic indicators is essential. I hope this episode gave you a clearer understanding of inflation and how to safeguard your money. If you enjoyed it, be sure to subscribe and leave a comment about how inflation has impacted you personally. Thanks for tuning in, and I'll see you next time.